I trade long-term buy rates, sometimes even though I can get a lower theta in a shorter term option. But the reason I do it is because of other benefits that in this case I find to be more important and more useful and more relevant to what I'm trying to accomplish.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, wealth building family, welcome to episode 25, Party Like a Pachyderm. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, consider sharing this podcast with like-minded people. Word of mouth is the best way to grow our community for all of us. And the more people you share ideas with and get that frequency bounce back we talk about all the time, the more you grow as a trader. The second thing you can do is to support the show with a paid subscription. For the cost of one of those fancy Starbucks once a week, you'll get video extra podcast episodes and option trade posts where I drill down on a stock, event, or trading opportunity and share trade rationales and chronicle my covered call and cash secured put trades that I'm making in my real brokerage account. Plus, you'll get access to our monthly Ask Me Anything session and much, much more. To get all this, go to my Substack at wealthbuildingwithoptions.substack.com and subscribe to the monthly or annual subscription. And I'd like to take a moment to give thanks to the patrons who already support the show. A very special thank you to Alex H., Bill H., VJ, Paul P., Nan Ron, Sean K., Steve D., Myron, Glenn K., Mark, Ann T., Spencer, John D., Douglas B., Ed B., Christopher L., Deborah, and Eric G. I don't do that enough, but without you guys, it would be so much harder to do this show. You help support our staff, Eric, who does a great job on the editing, Bobby, who runs the show in the background, and all the effort that we all put into this. And I just want to thank all of our listeners. Now, let's tune in to higher frequency trading. Last time we talked about short-term buy rates. And this time we're going to talk about long-term buy rates. And well, they're both buy rates. It's the same thing, right? Yeah, kind of, but kind of not. It's like you decide in your garden, okay, hey, I'm going to grow tomatoes. And oh, what are these? Oh, this looks like a tomato plant too. Tomatillos? Oh, yeah, I'll plant these too. And so you got your tomatoes and your tomatillos next to each other, and the one grows and it's like, oh, this is kind of a weird leafy paper shell around this one. And you open it up, and oh, no, it's not different. It's the exact same thing. It's just a tomato. It's green. Oh, okay. Oh, but it never gets ripe. It's just stays green forever. Okay, well, it's still a tomato. And then you taste it and you're like, wow, that kind of tastes different. And I can't make my pasta sauce out of it. What can I make it? Oh, make sauce out of it? Okay, so it's basically a tomato, but it's really kind of totally different. That's what it's like with short-term buy rates and long-term buy rates. They're like kind of the same thing. I mean, they're both buy rates, but they function just so differently. So when we talked about the short-term buy rights last time, one of the really important things in at least the methodology that I talked about doing them was that we needed a pretty high volatility because when we sold the option, it had to be sold at a decent enough percentage of the underlying price. So, yeah, the long-term buy rights, they're kind of just the same, but they're kind of different. They're kind of really more normal. But then there's kind of some unexpected stuff. And the most unexpected thing is theta. When we sell options, options lose their value as time passes. That is called erosion or time decay. And we measure that with theta. And the more experience and the better we get at trading options, really trading any type of options, we're always narrowing in on metrics, especially the Greeks. And right now I'm talking especially about theta and really trying to optimize it. If I sell a shorter term near the money option, I get a higher theta. If I sell a longer term option, I get a lower theta if it's near the money. If it's in or out of the money, well, that relationship is going to be a little bit different. You might get some unexpected things. But here we actually are doing these pretty close to the money. My long-term buy rate scenario is one where I'm selling pretty darn close just out of the money options. And so it is a little bit unexpected that we choose to do this longer term option, like a really long term option with these. Some of them are actually even leaps where we're going out about a year in time. Sometimes I'm going out more than a year. Sometimes it's maybe 9 months or something. So there's kind of a lot to talk about with this stuff. I trade long-term buy rights, sometimes even though I can get a lower theta in a shorter term option. But the reason I do it is because of other benefits that in this case I find to be more important and more useful and more relevant to what I'm trying to accomplish. And one of those things is, well, I don't want to say prediction because I never really try to predict a stock price. I always think of it as I'm just playing the odds, things that are more likely. But if we were to use that silly word in trading, predict, if we were to try and predict, it's easier to predict a year out in time than what would happen a day out in time, which doesn't seem to make any darn sense at all. But that's a truism when it comes to trading and investing. It is easier to predict what would happen with a stock over a year than it is over a day because there's so much noise in the market. Any silly short-term thing can happen, but value is value. And some of that has to do with how volatility just plays out over time, right? So on any given day, sure, you'll have some movement intraday, but it's going to be an up day or it's going to be a down day. And you can get some short trends. The next day might be an up day after today's up day. You might get 3 up days in a row. You might get 5 up days in a row. And then there's longer term trends. Maybe a trend for a month where the stock climbs higher and higher for a month. But here's the thing. If a stock climbs higher for a month, you don't have up days every single day. You have some up days and you have some down days and you have some bigger up days and some smaller up days and some small down days. and maybe even a big down day within that uptrend. If on any one given day a stock goes up $1, if there's an uptrend over the next year, 365 days or about 250 some trading days, you're not going to have 250 some up days. I mean, it just doesn't really make any sense. You can kind of think about it in your head as sort of like a bell curve shaped sort of thing. Really, what's in my mind is what is called a volatility cone, which some of you might be familiar with. The Thinkorswim users might have seen these on Thinkorswim. And honestly, I'll tell you what, I caution people away from using them as far as mathematically for various reasons that I'm sure at some point will come up on the show in the future. But for right now, let's just kind of gloss over that. But it's kind of a good example for what we're talking about. If you think about how volatility may play out in the future, the more time that passes, the less big the move can be away from the center. I don't know if I'm explaining that in a great way, but for those of you who are familiar with volatility cones probably sort of get what I'm talking about. It's just this idea that, I guess the best way to put it is like I said, if a stock moves $1 one day, I mean, it's not going to move in the same direction $1 every day. Some of these up days and down days balance each other out to smooth out what that volatility looks like over longer periods of time. So that said, we use the short-term buy rates in a similar way to long-term buy rates, but a little bit differently. And I think the best way to really understand this is basically just to jump into an example. So this is an example. I actually have used this. It's filling up chapter 7 in my book. It's just filling up a section of chapter 7 in my book that I'm working on here. The stock is AEO is the symbol. AEO, you know that one, don't you? American Eagle Outfitters. Well, if you don't, now you do. So I was looking at that stock in May, and it was trading at $10.96. And I looked at it, and look, I was looking at it as a potential investment opportunity. I don't even remember how I even became aware of thinking about it, but once I do get an idea for a trade, wherever that comes from, I go and I analyze it myself and decide what to do or what not to do. So, in analyzing American Eagle Outfitters, I saw that at the time it had strong fundamentals, but it did have some challenges. The last quarter's earnings, when I was looking at it, was a loss. And it was only the third loss over the last 20 quarters, but I mean, that's still like 12% of the quarters were losses, right? So, not really ideal. And that's kind of like when the tariff concerns were really like, oh boy, what the heck is even going to happen here? Which, if you're listening to this live, I don't know, we're kind of still in that boat a little bit, but I think there's a little bit less uncertainty involved. And at the time, the stock was down about 50%. And that really was because of the tariff concerns. And so I was thinking to myself, well, maybe that news is priced in. I got the good fundamentals. There is a little bit of support below. Here's what I think I could do. So, with the stock at $10.96, I decided to sell some leaps calls. The January 2026 11 strike calls at $1.80. So, all right. Again, I appreciate the fact that this is an audio only podcast, and sometimes it's hard to visualize this, but I'm going to make it pretty simple. Selling the calls at $1.80 on a stock that is $10.96. So if I took 1.8 and divided that by 10.96, that's about 16.4% of the underlying that we're taking in. Now, this is not like a crazy high volatility or anything. This is just the fact that it's a much longer term option. From May to January is like 8 months, right? So naturally, we're going to get a bigger premium. And so, sure, there's a smaller theta, but we're still collecting 16% of the price of the stock over an 8 month period. So it makes for some kind of interesting stuff going on here. My break even is $9.16 on that. And of course, how do we calculate that? Well, I mean, we just simply take $10.96 and subtract from that $1.80. 10.96 minus 1.80 is $9.16. So, I mean, basically, the stock can fall like 16.4% lower and the trade's still a winner. So basically, the stock can fall 16.4% lower and the trade is still a winner as long as it doesn't fall more than that. So if I'm presuming that a lot of the damage is already done and it's got strong enough fundamentals and it's got a little bit of support, so far, I kind of like this. And I also like the idea that even if it just sits where it is, then that's wonderful. If it just sits where it is, I actually make 16.4% on the cash that I have tied up in the stock. We'll talk more about that in a second. And then there's the if called return. So the if called return is if the stock goes up and is above the 11 strike at expiration, we'd make just a little bit more because, well, there's 4 cents between where the stock was when I put it on and the strike price. So we make a little more than 16.4%, about 16.8%. And actually, you know what? If we annualize that 16.8%, that comes out to a 26.2% annualized return. So the three numbers that we're looking at here is the break even, 16.4% lower or $9.16. The outperformance measurement, if the stock stays where it is, which we could call the static return, like the stock remains static, that's 16.4%. And the if called return, which is 16.8%. And because the strike price is so close to the stock price, the static return and the if called return are so similar that when we annualize it, either way, we can just kind of round it to a 26% annualized return as long as the stock doesn't fall too much, right? So this is similar to how we thought about the short term one, but it's importantly different, especially in one way that I already kind of mentioned a little bit already. So I think it's time to give the elephant in the room a name tag and a party hat. Theta. Why on earth would I sell a longer term option that has, it's going to have a significantly lower theta? Why would I even be doing that? Could I do better if I sold shorter term options? And the answer is, well, yeah, maybe. And the answer is also maybe not. You rack up a lot of commissions and you're investing more time in it, and it's more of a trade than an investment because I'm really, really thinking about this as purely an investment. And I've talked about thinking about things already, right? there's this saying, the more you look at things, the more things change, which is kind of actually rooted in like real physics, like string theory stuff, where like if you look at a particle, the particle actually can change forms in physics, like string theory, where if you look at like, I think the experiment they did was with a light wave. Like, if you look at it, it goes from a wave to a particle or vice versa or something like that. I don't know. I'm not a physicist by career or anything like that, but like, it's a thing. You look at it and it actually changes form. And it's kind of like that when it comes to option trading. Like, if you just think about the trade in a different way, like the trade actually does change. And I know it might sound like I'm being weird or like I'm not making sense or that I'm just freaking crazy, but I really believe that. So, with the long term option, in thinking about it, the most important thing to me is to think about it and treat it like an interest generating asset. All right. Now, it's not an interest generating asset. It is a stock that is combined with an option. Nothing like an interest generating asset, but it is like an interest generating asset. It's like a bond or an annuity or a bank account. Okay. If you think about, hey, I can take $1,000 and put it into this bank account. They have a certificates of deposit. Okay, let's just break this down into something really super easy that any pedestrian investor can understand. You walk into a bank, there's a sign that says CDs for 5% annual APR, right? I know that if I give them that $1,000 over a year's time, I'm going to make 5% on that. Okay, well, let's look at that as a benchmark. What else could I do? Well, I could take this trade. It would actually be $1,096. And I could sell this call that has about 8 months until expiration at $1.80. And that's 16 something percent of the price of the stock. Annualize that, that's 26 something percent. Okay, well, that's much better than the 5% CD, isn't it? Well, then I should definitely do this, right? Well, maybe, maybe not. The CD is probably guaranteed by the FDIC. And if you're a more savvy investor, maybe an alternative would be like a T-bill or something, which is guaranteed by the full protection of the US government, or however it is they say it. Well, this long-term buy right isn't guaranteed. There is a risk. The risk is that it goes down 16.4%. If it doesn't do that, if it just doesn't do that, you're going to make like a 26 something annualized return. That's a great annualized return, but it's risk reward, right? We've got that correlation between risk and reward. I am taking on more risk. Now, it's not crazy risk. We like the stock. We think that there's a floor in. We think that maybe it's oversold, overpriced in of a down move because of tariff concerns or whatever. And we're willing to take this risk in this scenario. But that's the game we're playing. We're getting rid of the FDIC business and the full faith of the US government and all that business. We're taking more risk to get a greater annualized return. And that's a big part of the reason why I like doing it just as a long-term buy rate. I could tool around with it and rack up a lot of commissions and make it more into a trade, or I could just look at it as a greater annualized return with this one bigger element of risk. and think about it that way and don't mess with it, right? I'm going to treat it like a Thanksgiving turkey. Just check on it once in a while, except it's not really like Thanksgiving. I mean, mom's not drunk, dad's not fighting with somebody. My daughter's weird boyfriend is in here, right? So a little different than Thanksgiving, but just check on it every once in a while. That's all you really got to do. As you get closer to expiration, well, then you might be able to buy back the short call at pennies, 10% of what you sold it for, and maybe sell another one. And now you can do that adjusting the strike that I like to talk about when we talk about rolls, where maybe if it is a little bit above the strike, well, you buy it back for whatever it is and sell a higher strike. Or if the stock's a little bit lower, then maybe sell that same strike or even sell a little bit of a lower strike. It doesn't really matter. If the stock's down a lot, then you have some different decisions to make, but that's all kind of part of it. Now, this thing about annualized returns, we'll probably talk about this every now and then on the podcast because it's worth kind of refreshing your memory about it time to time because annualized return can be a really, really great way to look at things, but it can also be a pretty misleading way to look at things. And I actually kind of plan on drilling down on this a little bit more a few episodes from now, so I don't want to steal my own thunder here or anything like that. But if we look at annualizing a return from the get-go and think about some of these investing ideas when it comes to using covered calls or cash secured puts as an interest-bearing thing, bond or annuity or bank account, and how much do I get on an annualized basis in percentage terms, and what is the risk trade-off for getting that higher return than I could get from the risk-free rate, which is what people call T-bills and treasury bonds and that kind of thing from the US government. Although, at the rate we're going a few years from now, they might not call them that anymore, but we'll see. But that's the way that I look at it when it comes to longer term investments like this, is looking at it from that annualized return. But if we're doing it on a shorter term basis, looking at it as an annualized return kind of loses its luster a little bit. Because I mean, this trade I'm probably going to have on for several months. It is a long term trade. If I'm trading something that has 2 weeks until expiration, I make a 30% annualized return. Well, that means I've got to repeat it every 2 weeks for a whole year in order for that to actually mean anything. This one, I'm going to hold it for months and months, a good part of a year. It like literally is almost an annualized return already. So that's how I think about it. And I think that that's really useful when it comes to setting up trades and not stroking your own ego after the fact. And there are other iterations of this as well. Just looking at it as a straight long-term buy right. I mean, another iteration of it could be selling a somewhat higher strike call. Now, usually when it comes to long-term buy rights, I'm not going too far out of the money and giving myself too much room to run with the long-term buy right because that downside protection is a really big, important part of it. I kind of want that fatter premium. And so I think about it more in terms of the interest bearing thing as opposed to room to run making money on the stock. I kind of take that out of the equation typically. But, one thing about using a higher strike with longer term options, especially in this environment where we do actually have an interest rate, I've been teaching options for almost 20 years, and I spend most of that time not even being able to talk about what I'm about to talk about because the interest rate was zero. And so there was no row. interest didn't affect option prices at all, but now there is. And when interest rates are higher, that makes call prices higher. And it makes what I think of as the effective at the money higher. So, like a 50 delta call that has 9 months until expiration isn't going to be at the money. It's going to be a much, much higher strike. And so, because of that, you're able to sell with longer term options, a higher strike option, somewhat higher strike option at still a really, really good meaty rate because row plays into there. The interest portion of the value of the option is bigger. And that's just an extra added benefit. So that is one thing that we can do is we can look at it as a little bit of a hybrid from what I talked about in today's episode so far and what we would typically think about with a covered call. So selling close enough to the money where I'm getting that fat premium and a lot of downside protection, but maybe giving a little bit more room to run to the upside. Let it be able to make a little bit if it goes up, right? And that just becomes really, really beneficial too. That ends up kind of being sort of the best of both worlds. And man, I like to do maybe for each chapter of the book, 2 or 3 podcast episodes. And this one is just a typical average length chapter. This is chapter 7, where a lot of these concepts are coming from. But man, we're going to do at least one more episode all on chapter 7 too, because there's another thing that I want to talk about that's very similar to this, but just adds one more little piece to it that can make it really, really interesting and really, really powerful. So that is going to be coming up. And that about wraps it up for this episode. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. Because when you do, you will be the first to hear episode 26. And that episode is going to have a very special guest. I'm inviting a good friend of mine to talk about some really, really fun and interesting and useful things. I'll see you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.